Joseph, gold price down big time, but now we've gone through levels now where it really looks like we're not going to be coming back to those old highs, no matter what fantasists think. What are the implications for the gold miners?
I think you're right, and I think the fall below $1,200 a troy ounce is that moment where you have to think, well, the dollar is rising, real interest rates are also rising in the US. Those are never particularly good for gold. We need to think about the long term. And if you're investing for value and you go to gold miners because, unlike gold, they actually have cash flows, you should be looking at what costs they can cut and how they can raise cash flow if prices stay low for a long time. And you have to bear in mind, at the moment, the S&P TSX Global Gold Index, which is this fairly benchmark index for gold miners, has a market cap of about $95 billion, which is half of Facebook.
Oh,
that is not a lot of value.
So sad, but a mark of the times. And so when we're looking at costs, what costs should we look at? It used to be that we just looked at cash costs. Now I think we've got to include the capital cost, don't we?
Yeah, so the World Gold Council, which is this industry body, has been encouraging miners to report their all-in sustaining costs. And actually, that's probably a good idea for miners in general, because all miners like to talk about their cash costs, which are, per unit production. But you have to build mines, you have to kind of keep production going, and you have to go looking for reserves, and that exploration has costs. That particularly affects gold because reserves have been declining for some time. You have to dig a lot of dirt to get a few grams of gold, basically. And miners have, over the last year or so, been reporting those costs. The problem is, quite a few of them have costs above $1,200. So there's an issue there. So shareholders kind of know what to look at in terms of costs. Miners still have to explain how they can get those sustaining costs, those long-term costs, down.
So what do you think is going to happen here? What remedy is there?
I think the answer is some dissolution of gold mining companies, actually, because we've been talking about the all-in sustaining cost. That's usually reported as an average by companies. If you look at Primero, for example, which is a Toronto-listed miner with assets in North America and Mexico mostly, it reports an average cost above $1,200, which sounds pretty bad. But its biggest mine in Mexico has an all-in cost of just over $600, which sounds actually absolutely fine in terms of where the price is at the moment. So what I'm saying is there can be this big variation within a gold miner's portfolio, and that can be quite hard for shareholders to price in terms of what they sort of want from a company. So the company should make it easier, and I'm not saying Primero should do this, but others might consider doing it, of actually just spinning off assets or selling them, or in general rationalising their portfolios. Like this moment, when prices are low and may stay low for a while, is the moment when you can really sort of take costs out and decide what you want to look like as a company.
Okay, that's very interesting. Thanks very much, Joseph.